Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is November 7th of 2022. Now, I know I was away last week, was feeling a little bit under the weather, so thank you for everyone's patience on that front. But as it relates to this week, we're going to tackle really the last 2 weeks, and we want to answer that question of, are stocks going lower? Now, of course, we can never answer that question in the affirmative at 100%. But we can provide a framework. We can provide, what are those dominant long-term trends that are in place, and whether or not policy remains a headwind or a tailwind to stock prices. And as it stands today, right now, the macroeconomic backdrop is one of slowing growth. We're seeing it on the earnings front. Company after company cutting guidance. Yes, there's certain economic reports out there that look okay and keeping the Fed restrictive. But overall, inflation remains sticky. Corporate earnings are guidance is getting slashed across the board. We saw that with the dominant FANG names. And overall, the Federal Reserve remains restrictive. They continue to hike interest rates. They're now talking about a potential terminal rate far above 5%. Remember, over 80% of the time in history, the Federal Reserve's interest rate policy was above CPI. CPI right now, or otherwise inflation, is over 8%. So put those two numbers together, and those historically are not very good for asset returns, in particular stock returns. So we want to be cognizant of that. I think now is the time to continue to be careful, a time to play defense. And where we think that there's money to be made is more on the short side versus the long side. There are areas such as energy that we like and healthcare that we think remain opportunistic. But overall, this is a fairly defensive market tone, and we want to communicate that through our stock positioning in the portfolio. So let's go ahead and get started for the week. Now, one of the challenging aspects, of course, of staying defensive are those bear market rallies. 2 weeks ago, that was vicious. I mean, we had a 10 to 11% rally in the S&P 500 off intraday lows from 2 weeks earlier, and it was really, really painful. But if you respect the trend, you do your homework, a lot of the times the market comes back to you. And what we saw this week in particular was that the Federal Reserve instilled reality back into many of those market participants that were hoping, remember, hope is not a strategy, but we're hoping for a dovish pivot by the Fed. Now, the reality, of course, is the Fed did pivot, but they pivoted to even higher rates, 75 basis points in November, of course, and then likely somewhere between 50 and 75 in December. That's a lot. We have to remember that. That's a lot. It was way back in the 90s when we saw 50 basis points before this current round. So 75 many times over is very, very restrictive, and monetary policy acts to the legs. We haven't really seen the impact of the economy yet, but we are starting to see that in corporate earnings guidance. And I think you're seeing that play through into stock prices this week, down 4 or 5, or last week down 4 or 5 days, especially after the Jerome Powell press conference. So to this week, we're going to go through why we remain so bearish on stocks right now, the nature of a bear market rally, because they can be vicious, they can be enticing, right? And then lastly, a review of corporate earnings so far. I do want to point out this chart here on the right. This is the S&P 500 number of days without reaching a prior high, okay? So this has been the number of days so far. We look way over here to the right. This is the number of days, about 200 or so, just over 200 days without reaching a new high. When we go back to 2010 to 2014, or from 2002 to 2007, or in the 70s, these major bear markets can go over 1,000 days without reaching a new high. So we're still very early on here in this bear market, in our opinion. Of course, we knew that the market was desperate for a pivot. This is, if we look here at the chart on the left, this is the number of times pivot was mentioned across the media. We can see just an absolute spike. When is the last time we saw something similar? Was, of course, when the Fed continued to talk about transitory. Remember, inflation is transitory, transitory, transitory. Well, guess what? It wasn't transitory. Now that everyone's talking about a pivot, pivot, pivot. Well, what did the Federal Reserve say on Wednesday? We are not done. More ground to cover. It will be inappropriate to talk about a pause, and people need to understand our commitment. And then Jerome Powell finished it with saying, I control these messages. A very dominant and a very hawkish message from the Federal Reserve that's saying, yes, even if we only do 50 in December, that's not dovish. We're just getting going in terms of the 50 rate campaign. In other words, we're breaking apart those rate hikes, but we want to get to a higher level at the end. So in other words, we're not finished at 5, maybe we're finished at 5.5 or 6. So that was a very, very hawkish message. Now, the week before that, the market rallied. And the prime reason the market rallied was because of Apple. You know, Microsoft, Google, Meta, Amazon, their quarters were disasters, right? And there's going to be much more pain ahead, in our opinion, for these particular group of stocks. Because if you look at almost all U.S. equity funds, the top 5 holdings, top 10 holdings are dominated by these names. And that tends to happen during sort of these bubble market cap peaks in the market, where the same names dominate across all these portfolios. What that really means is that these portfolio managers at some point are going to have to chop these weights down. Just go through, if you own some mutual funds or some ETFs, take a look at the top 10 holdings if they're a U.S. equity fund. I almost assure you that you'll probably find these names that are dominant in the top 10 lists. And so, you know, Apple's quarter wasn't a disaster, so it went up went up about 7% that day, 2 Fridays ago. And sure enough, we've given back all those gains and more over the past week. Apple now sitting at 2 to 3 week lows. Why? We got to remember, Apple pulled its guidance, and then they announced this week that they're freezing new hires. Companies don't do that when things are great. So we have to remember that we can't get caught in this short-term rhetoric that we see in the media, or that we see in the short-term price action of stocks. It's really important. I mean, I think it was on CNBC last week where Jim Cramer was literally bullish and bearish within a 7-minute time span. Remember, the media's job is to sell anxiety. Anxiety sells eyeballs, and eyeballs sell ads. And that's how these companies make money. They don't care if your investments go up or down. Now, the other thing we have to remember, Apple is 14% weight of the NASDAQ. So it does have a disproportionate impact on what you see the indices do on any particular day when these stocks move in one direction or the other. And of course, you can see that here with that earnings head fake. Apple rallied. This was the day it rallied on earnings. And then reality began to set in over the next 5 days, last week in particular. So why are we short? I really wanted to address this. The Fed is hiking rates into what we see as a pending recession. We have not faced this type of cycle in decades. When the Fed does this, they usually break something. We don't know what they're going to break, but they usually break something. Number 2, inflation faces a long path back to 2%. Once inflation historically gets above 8%, it takes about 2 years to get back to 6%. The Fed wants this back to 2%. So we think people are really underestimating how sticky inflation is. And then, of course, earnings are beginning to contract. Very important point here. If you strip out the impact of the energy sector, S&P 500 earnings so far are down around 2 to 4% year over year. In most recessions, those earnings go down around 18 to 24%, 18% if you strip out 2008 and 2000. We don't think you should strip out 2000 or 2008. So it's around 20 to 24%. So we have a long way to go is what that means. The other thing that's really keeping us awake at night is this yield curve, right? So the 2-10 yield curve, again, is record inversion. So in other words, what this is saying is that the 2-year yield is far above the 10-year yield, which tends to predate recessions. Why? Because the Fed is hiking the short-term rate, and the 10-year yield is a reflection of future growth expectations. So when the 2-year goes above the 10-year, it's saying that future growth is going to slow dramatically relative to present day growth. So that is something that's keeping us awake at night. This inversion, these types of inversions, especially how quickly it's inverted, has tended to, in history, follow pretty severe recessions. And, a chart says 1,000 words. This is the chart of Amazon right now. This is a broken chart. This is broken leadership. The leadership of the last 10 years is falling apart. Whether we look at Amazon, Meta, Google, not Facebook, Facebook is Meta, but Apple, all of these charts are breaking apart. So we don't want to try and catch these falling knives. We talked about inflation and how it takes about 2 years for inflation to get back to 6% once it has crossed 8%. Why were people talking about a pivot? We're at core CPI is currently, we'll get November or October's read next week. But as of September, we're sitting at cycle highs in terms of core inflation. So very important that we don't get caught up in the rhetoric of the media. Meanwhile, from a macro perspective, pending new home sales continue to decline, and the home prices year over year experiencing their sharpest decline in over a decade. These are flashing yellow lights to investors. Yes, the market's been bad this year, but we think that's really only phase one of the current bear market. So what would make us wrong? What would say to us, hey, you know what? This bear market's actually coming to an end. We need to reposition and get long stocks. If inflation shows signs of collapsing while growth is stabilizing, in other words, the Federal Reserve is going to pivot and start to cut interest rates. And of course, if we tie that in with China reversing course on COVID and foreign policy, and we start to see China as a contributor to global growth, not a headwind to global growth. Getting a lot of rumors this week about COVID policy in China. We think we need to be careful there. There's been a lot of false starts in China. Wait and see. There's no need to rush and play the China trade. Where we would prefer, if you're going to do that, is in energy, because we love energy right now from a long-term perspective. So the bottom line is we had a sharp bear market rally toward the end of October there. We stomached through that. And now we're overbought. We were overbought ahead of that Federal Reserve meeting, and of course, have come back down. The bear market rally lasted a few days longer than expected, but we saw again that big correction this week, which proved to us that our patience was well warranted. Aggregate earnings for the S&P 500 X Energy are now negative year over year. And of course, huge equity inflows in the month of October chasing this bear market rally are very dangerous ahead of a continued Federal Reserve board that it continues to tighten policy. So that's what we have for you this week. 888-543-3776 if you have any questions. Thank you again and have a fantastic week.